In this lecture we are going to learn an idea that serves the purpose of leveling the trading playing field in terms of risk-taking. It's not an absolute necessity to employ the techniques of risk contraction and expansion, but if you want to obtain the full effect of the margins of error of the various risk-reward ratios, you need to level the risk you take in all trades. In real-life trading, the size of your stop losses will vary. That means that the good properties of risk-reward ratios can get a little distorted to the worse side of the spectrum. For example, imagine that you have this series of 4 trades. You can see that the size of the stop-loss orders varies quite a lot in terms of pips. The largest stop is 30 pips and the smallest one is 5. If you end up being right on the smaller trades and wrong in the larger trades, your margin of error can suffer. This is where the idea of risk contraction and expansion comes into play. The goal behind this idea is to use leverage to make all trades risk the same percentage regardless of the stop size. That way, no matter how large or how small the stop-loss orders are in terms of pips, you will always risk a fixed percentage of your account. You can have a clearer view of your margins of error in that way. Let's see how we can calculate the trade size with a simple formula. The formula is quite simple, and it goes like this. The trade size in lots equals the arbitrary risk in terms of capital divided by the size of the stop-loss in terms of pips divided by 10. To discover the arbitrary risk in terms of capital, we need to know our equity and we need to define an arbitrary risk percentage. For example, let's say that we have $100,000 and we want to risk 1% of that in each trade. Our arbitrary risk in terms of capital equals 100,000 times 1%, which is $1,000. We divide that number by the size of our stop loss in terms of pips, which is 20 in this example. Then we divide that number by 10, because we know that one standard lot has a pip value of $10 per pip. The formula returns the amount of lots we need to purchase in order to make our trade risk exactly 1% of our equity with a 20 pip stop loss. Let's do the reverse calculation to prove our formula. We know that one lot gives us $10 per pip. The formula returned 5 lots, so our trade would function with $50 per pip. If we got stopped out, we would lose 20 pips at $50 per pip, which gives us a $1,000 loss, which is 1% of our equity. This is how you can quickly calculate the size of your trades if you wish to level the playing field in the way that we described in this lecture. In the next video, we are going to talk about different methods of position sizing and how you can grow your account in an organized way.